that recovery in the bond market, taking a look at that now, coming in a little bit after Treasuries saw their biggest sell-off in 2 months amid that hotter than expected inflation data reading coming in yesterday that pushed out rate cut expectations. Joining us now with more, we've got Blake Gwynn. He's RBC Capital Markets head of U.S. rate strategy. Blake, great to have you on to kind of talk through what's going on when it comes to the Treasury market and the reaction to inflation. What thesis can you derive from both what we saw in the 10-year with the sell-off and then coming in a little bit today?
So I think we came into this print, the CPI print yesterday, kind of expecting a repeat of the seasonality we've seen in the last few years. Everybody kind of knew it was going to come in a bit hot. We just didn't know it was going to come in that hot. So I think the fact that we had that sell-off yesterday, clearly it still took a few people by surprise. I think there was this kind of growing narrative just in the week before the print. So it kind of went too far and then pulled back a little bit, where some people are coming out and saying, well, after 2 years of this, the seasonal adjustment factor should be starting to kind of normalize. Maybe it's not going to be as bad this time around. This year is probably a bit softer than the last two. So then when it actually showed a bigger swing from December to January, I think that spooked a few people. That includes the Fed. I mean, we heard from Powell yesterday. He certainly seemed a little bit rattled. He kind of moved his goalpost a bit, saying, I'm focused on those year-over-year numbers.
Right. But
that year-over-year core went from 3.2 to 3.3. Everybody was expecting it to go down to 3.1. So even that wasn't totally fantastic. He did point to PPI today and how that would read through to core PCE, as you guys were discussing. That looks relatively benign at this point. But I would also note that one of the main doves on the committee, Goolsbee, was actually out yesterday saying this was a sobering print on CPI. So if you have a dove kind of taking a bit of a step back and saying it's sobering, certainly means something.
Is it sobering because if we were to see more prints, or at least a trend of prints where you saw the month over month actually usurp or invert against what we have seen in wages, and that having a larger impact on the mindset of the consumer, is that what they're trying to run the calculus around, or at least get ahead of and start the conversation?
Yeah, and I think even if we know that some of this is a mechanical issue around the seasonal adjustment process, optically, it just makes it difficult. And I think, time and again, we've seen, I think the progress the Fed has wanted to see just keeps not quite being there. It's just a little bit ahead. And so I think they've just kind of had to continually keep rolling out their time frame of when they're going to get back to that 2% target. But I think what is very true about this print is it makes it very difficult to think about resuming those cuts anytime in the near future. So even if it's mechanical, even if they can kind of write it off and say, well, the pass-through to core PCE is not that bad, it's just very hard to come back with a cut in March and probably even May.
How soon do you think that first cut is?
So we don't have any more cuts. Our forecast, and we've been here for a while, we actually think we're already at the terminal rate.
Can we talk about that? Because Powell, to me, the news coming out of Powell's testimony this week is that he sort of teased that the terminal rate might be higher than the market is necessarily pricing in right now. What is it going to take for bond investors to get on board with that? And do you even agree with that idea that the market is not ready for this to be neutral?
Yeah, and I think something notable about what Powell said, it wasn't just that neutral may be higher. He also said we should stay restrictive for now. So it's not just where that setting is. He's saying we should also be beyond that setting for the time being. I think part of our view, we had essentially been calling for a 4 to 4.25 terminal rate for most of last year. And a big piece of that was that we thought the short run neutral rate, so maybe not the long run dots that you see in the Fed's, in the Fed's forecasts and things that a lot of these longer term models would suggest, but the short run neutral rate for the economy was actually a lot higher than people were expecting, including the Fed. And I think there's a growing awareness of that. I think you've seen a lot more Fed members kind of talking about, well, maybe neutral is this range that extends up to the 4% type of level. So yeah, I definitely think they've come to that realization that neutral may be higher.
It makes me wonder if the bond market is getting on board with that idea. I want to throw up a chart from the past 48 hours here that we can take a look at the moves that we've seen in the bond market here. It was interesting seeing the initial reaction on the 10-year. Yields kept climbing even after other maturities started to calm down just a bit. And I wonder if that indicates to you that the market is starting to get on board with the idea that this could be neutral.
Yeah, I mean, I think yesterday was just a bit more of a kind of washout. I mean, certainly, I think the market is coming to terms with that. You see the Fed pricing starting to kind of flatten out. We're taking out remaining cuts. You guys mentioned a few of the calls that are kind of coming more in the direction of where we've been, which is that, there's not really cuts coming, and that actually the bias could shift towards hiking by the end of this year. So that's kind of where we've been calling it.
When you think about the Fed's long run 2% target? Do they need to come off of that 2% target, knowing that we have a much different scale versus what we were using 2% as our kind of North Star as in decades prior?
Yeah, we'll see. I mean, Powell was asked about this yesterday. They just started their review process of their framework. So I think a lot of people are looking at that process, wondering if there will be some change to the way they're targeting inflation. They've been using this flexible average inflation targeting scheme. People call it FATE. You've probably heard. So there's some talk about
what. Needs a new name.
It's pretty tough. It does allow for a lot of puns when we're writing our pieces, but no. I mean, I think we're going to see where that process goes. I think there's a very good chance we could see some minor tweaks, but I don't expect them to come meaningfully off of that 2%. I think there's you can look at some studies throughout the last 20, 30 years that suggest that 2% actually is a pretty decent level. When you go up to 3%, some things start happening that the Fed probably doesn't want to open the door for. So I think they probably stay at 2%, but maybe the way they target 2% changes a bit.
So then, is there a plausible scenario where we could get a hike this year off the back of some of this sticky inflation data?
I think it's certainly plausible. I mean, I think one thing we're watching a lot, obviously we're all talking about tariffs. I think some of the bigger risk to a potential hike is actually coming from the immigration side. Tariffs, I think to some extent, the Fed will look through one-time direct price increases. If you're seeing a pass-through of those tariffs to consumers, they can kind of write that off to some degree. It's something that I don't think is a very good use case for rate hikes to counter because it is coming from tariff policy. So I think the scale back in the labor force, and if we start seeing wage pressure coming from the continued declines in immigration, that could actually be more meaningful for the Fed and could be something that I think is more risk of a hike later this year than even tariffs maybe.
Interesting. Blake, great to have you here in the studio with us this morning. Really appreciate it.
Thank you.